Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. We have a busy week. We're going to film EIA, Econ, where we have the Primary Vision Frac Spread Count coming out today. And then we also have a conversations with Adam Anderson, the CEO of Innovex, which is going to be, it's interesting just because we're going to talk about what's happening in the lower 48, what are the expectations coming over the next couple of months. And then obviously we wrapped up with his open letter to North Face. So in the EIA show, which we're going to talk about right now, we're going to do our normal overview, refined product demand, and then wrap it up with a global look at oil and refined products. And we'd like to remind you, please like, share, subscribe. Your support is appreciated. And we do have our end of year report, which continues to sell out. So it's exciting to see it moving. It's great for, it's just great for corporate planning, understanding what's happening in terms of horsepower. Where is it? How is it being utilized? What basins is it level? What basin level? And then we also have our breakdown of NGLs and then the China and what to expect going forward. So now that we can get into the EIA report, we had a small draw. It was a draw of about 560,000 barrels. It missed estimates. Estimates were for a draw of about 2.9 million. It comes mostly off the back of Pad 5. Pad 5 had a draw of about 1 million. Pad 1 had a small draw of 720,000. Again, those are more timing delay issues in terms of where those timing delays are. SPR everything's pretty much wrapped up with what was in the Strategic Petroleum Reserve. So right now there's not much to report. As we've been saying, Cushing pretty much flatlined. There's not too much coming in and out, and we'll go looking at that in a bit more detail. And then obviously production's holding firm at about 11 million barrels, which our expectations into year end is that 10.7 to 10.9, but just given where we sit, it'll most likely be closer to 10.9 million barrels as we kick off 2021. So here is the look of total inventories as we include the Strategic Petroleum Reserve. You can see there's not much movement after that big spike up that we had earlier in the month of about 15 million barrels. There's been a little bit of a drawdown, but again, nothing too crazy. As we turn to Cushing, Cushing, as we said, that was going to happen after that little spike and then coming down. We're just going to flatline here. We were expecting a little bit of an increase, but again, it's just going to ebb and flow based on what the spreads are doing, what the pull down into Pad 3 looks like, or the Gulf of Mexico. And right now, we have seen a little bit of an increase into Pad 3, but there's obviously production has increased. So there's a bit more of a backfill, which is going to keep us fairly flat into year end, and then to kick off next year. This is commercial stock. This is when we're excluding the SPR, the Strategic Petroleum Reserve. So here you can see we still remain at seasonally adjusted all-time highs as we head into January. Just given where we sit right now on the demand side, on refiners and what refiners are doing, there's really not going to be too much of a drawdown. So we'll maintain this pace. The question is going to be what happens when the tax man shows up, because as we all know, for those that have been following the EIA data and just oil in general, Texas will start to come around to tax barrels that are in storage. So we typically get some movements to try to mitigate or at least lessen that tax bill. But given some of the losses that we've seen on the corporate level, there might be enough to offset, so we won't see the same type of adjustments. But again, these are things to consider as we head into year end. And specifically, that speaks to Pad 3. Obviously, even after we've had that increase in the beginning of December, you can see that we've still maintained all of that, or most of it at least, within the Pad 3 region. Just because even though we've had exports increase, imports have remained elevated, and we just are not seeing the refinery throughput that it's in line with what we were expecting. But again, it's still well off of the average, or at least a seasonal norm, which is keeping us elevated just because there's not that demand on the refining side on the throughput. So when we look at imports, right now, if we look at what's happening, crude oil, In general, we had an increase of about 141,000 barrels a day. It was pretty evenly split, except for Pad 4 or the Rockies, which had a big increase of 221,000 barrels. That is more of a timing component, really kind of building up ahead of a bigger push in terms of total demand or throughput going forward. As they prepare for a distillate, making sure that they have the means to meet the coming winter surge. And then the interesting one is Pad 3. It's a small increase of 45,000 barrels, but you can see that it's fairly in line with year over year. Obviously down over the 5-year average. But when we look at Pad 2, small increase, but still down, and we'll talk about that in a minute. And then obviously Pad 1 and Pad 5 is always just going to be timing delays. We don't see too much coming into Pad 1 or the East Coast just because we have fairly large stocks as we head into not essentially the core of winter, and as we head into a slow, what appears to be a slowing period for driving. So again, that's going to mitigate some of the imports, and then Pad 5 is just going to be timing, just based on what we're seeing in the water. Crude runs were down about 1.1%. So instead of going from 79.1% to about 80, we pared back a little bit to 78. Again, this is more a preparation for the holiday as we have Christmas this week. This is because this is looking at last week. So typically we start to see a reduction. That reduction will maintain through this week and then start to increase, because we still do believe that we'll exit December and then start January at about 80% throughput. 80% utilization rate, which is, if we think about a throughput component, you can kind of see the adjustments. Pad 2 was the biggest decline. That's something that we don't see changing too much. We'll see a little bit of an increase, but again, not much overall. Pad 3 is going to pretty much hold firm at these levels as we go through this week. So again, there's really not much to say that there's going to be a bigger increase in oil throughput, which is, again, being reflected in the water and in the import expectations and numbers. Implied demand, it's not surprising to see some of these things. So one, let's take it, gasoline. Gasoline had a small increase of 47,000 barrels. Again, we'll see another increase just because it comes down to timing. And again, we keep going through this, but just to bring it home again, this is looking at from the refiner and storage to the rack and getting prepared to go into the market. So as people go and fill up and prepare for their travel this week, they fill up on Friday, Saturday, or it's a seasonal norm. And it's things that normally happen. Obviously, it's not happening to the same level this year, but there's an expectation. So that's why we start to see some of this increase in movements from storage to the rack, to make sure that we can feed the beast at the local gas station. So again, this is something where we'll see that continue. You can see it's small. It's obviously almost 1.3 million barrels a day off of last year. Not surprising. Distillate had a little bit of an increase of 172,000 barrels a day, still below the 5-year and the year over year, but we were expecting this rally just based on the amount of trucking that was going to move through, because this is the last push until we get another break for the holiday, as we saw in Thanksgiving. Propane, it's just going to be lumpy. It's going to continue to ebb and flow along these levels. So we're down 379,000 barrels a day. We'll see that recover next week, this week and into next week, just as, again, just positioning. So it's a positive because we did see some growth, but again, this is still keeping us well off of where we should be on a year-over-year level. Here you can see crude oil floating storage, still nothing in there. It's things have cleaned up a bit on the coastal side, so there's a pretty steady flow coming through the Gulf of Mexico into Pad 3. We will start to see some backlog just because we've increased some of the purchases from Iraq and Saudi Arabia, which is being reflected in their numbers, which we'll talk about in segment 3. But you're getting an idea that we'll start to see an increase. But again, even if we get a couple of boats out there, we're still well off of where we normally are. So there's really not much to say one way or the other. Well, all we can say is that we'll see some of this increase, especially keeping some of that crude out of tanks, try to avoid some of those payments. But again, this is something that's going to remain reduced. Pad 3 imports, as we said, thought we were going to get an increase along those lines at that spike that we normally get on the bottom of the cloud. But as we said, we thought we were going to stay outside of it, still make those the new seasonally adjusted all-time lows. Boy, I shouldn't say all-time, just because we're looking at the 5-year, just based on things that are a bit more relevant, just because we've inherently imported more versus previous years, just because if we go back in time, we're consuming more today than we were in 1995, 97. So again, this is on the 5-year, but you can see that on the 5-year level, we're making those new seasonally adjusted lows. And there's really nothing to say that that's going to change, just given the limited amount of movement on the refining side, which would be that pull through. So when we look to Pad 2, we thought we were going to get a bit more of a bounce, just because when we look at spreads, the WCS, or the West Canadian Select grades, and some of the other Canadian grades have started to trade at a much wider differential. So we thought that was going to help incentivize some of the movements into Pad 2. Here you can see that we got a little bit of a bump, but nothing like we thought we were going to come a little bit closer to that 5-year, the 5-year average. We obviously didn't get there. That's something where, again, there's a certain amount of timing, there's a certain amount of purchases, but when we then connect it with, Pad 2 had the biggest reduction in refinery throughput, then obviously if they're reducing the amount of throughput, then they'll reduce the amount of imports to try to marry that. This is something that's playing out right here. So we'll start to see that reverse as we, not so much this week, but as we go into next week and we get some of the additional capacity coming back as we head into the end of the year, and then as we prepare for January. There was a crude derailment, and this is, again, why we keep talking about the importance of pipelines, the importance of having fixed assets. A train derailed just outside of Seattle. Unfortunately, it was currently on fire when we were looking at it. I know that they were looking to put it out, but again, when you increase moving flammable materials on pipelines, you have a certain amount. It's a fixed asset. It's buried and/or is something that's highly monitored, versus something that is moving, is open to human error. The elements as rails break. These are things that we have to consider as we're trying to look at a sustainable infrastructure to ensure not only safety but also a reliable usage of the products themselves. And when we look at refinery utilization rates, you can see that we normally start to see an increase this week, and we start to see that increase continue through the end of December. Clearly, we're shaking that. It is year of 2020, but again, it's something where at the very least we normally flatline at about that 80% utilization rate. You can see going back to 1991, we're hitting new seasonally adjusted all-time lows. It's something where we think we're going to get closer to the bottom of that cloud with that 80%. We'll see this decline to 78, see either a little bit additional decline or at least flattening out here as we head into the holiday season. And then we'll start to see that increase. And as we keep saying, we expect to close at that 80% as we head into December. And we just don't see much coming back, just given the demand structure, what the exports look like, what our imports are looking like, and how this is going to kind of have a backdrop as we head into the end of the year. And then in the next segment, we're going to go a bit deeper on what are some of the demand drivers and what are we expecting as we head into not only this Christmas season, but also New Year's, and then how are we positioned heading into the first half of 2021.